Well, we have Ashish Gupta, CIO at Axis AMC, is with us. Ashish, good morning. Great to have you with us here. Prashant this side. Thanks very much. You know, as some people have jokingly described it, but I think the description fits accurately. This is a market in liquid oxygen. You know, that old Ajit saying, "Jeene nahi dega, marne nahi dega." It's like, there's enough on both sides, right?
I agree with the sentiment. I think if you look technically on the market, you have the macros that support it. I think we are also seeing a fair degree of resilience in earnings. I think this quarter, after nearly 5 quarters, we have kind of stepped away from the earnings downgrades that we had been witnessing. So I think the macros support the market, domestic flows support the market. But on the flip side, we continue to have the challenge with the large pipeline of IPOs and stake sales, right? And if you look at the data, just in the last 90 days, more than 60,000 crores of IPOs have happened. Over the next 1 month itself, another 30,000 crores of IPOs are slated to come to the market. So I think the fact that domestic flows and SIP flows continue to be strong is offset by this continuous supply that we are seeing. And again, IPOs is only one part of the supply. And if you see some of the data about non-IPO supply, so for example, companies that had IPO'd in the last 6 months, about $30 billion of stakes will be getting out of lock-in over the next 6 months. So unfortunately, this pipeline of supply does not seem to be abating anytime soon, and that kind of keeps the market upside more moderate.
I think sometime this week we'll hear more on Misho's IPO too. Perhaps the price ban and then the opening would subsequently follow. And that's going to be a big one, keenly tracked. Ashish, morning. This is Rima here. So as you look ahead to 2026, what are the big predictions that you are making? What do you expect? India's performance relative to global peers, will it reverse the underperformance? I mean, what are your thoughts about next year? And give us your top 3 predictions.
Sure. So I think clearly this year, thankfully, on absolute basis, India has not done too badly. We are still up a high single-digit percentage, particularly in the Nifty. The broader market, the small caps may not have done as well. But I think it's not been a bad year for the overall market. We'll end the year on a positive note. Where we kind of have struggled is on a relative basis. This has been a year of global equity market rally, particularly with the dollar weakness in the beginning of the year. Many global markets have been up in dollar terms between 25 to 35%, and we have not participated in that. Looking at next year, I think we can be more confident in saying that relative underperformance should go away. I think the challenge will be what's the degree of absolute outperformance that we will have, because given where valuations are, given the magnitude of supply that is coming in, big gains in the market look unlikely. I think what is very positive for the market is that in the last 6 to 9 months, we have seen a lot more affirmative action from the regulators, RBI, SEBI, as well as the government. And I think really we, after the challenges we have had on the tariff front, there is much more the sense of urgency in the government to take action to support the economy. We have seen reforms on the GST side, more recently on the labor code. We are going to see in the next month and a half, the new insurance bill coming through the parliament. There are more capital market reforms that are on the anvil. And another big activity that is being undertaken is deregulation. So there is a committee headed by the cabinet secretary that's driving this. There are also several provisions around decriminalization major laws that are coming through. So I think that is really what will continue to spur the economy over the next 6 months. And that makes us more optimistic that the earnings recovery that we are seeing should sustain into next year.
All right. Hi, Ashish. Good morning. Good to see you. And Nigel on this side. Ashish, I wanted to ask you about the RBI action. What's your take? December rate cut is something that the street was expecting. You suddenly had some weakness on Friday, on the Indian rupee, which, gave you a little bit of a jitter. But otherwise, inflation down. I think the CAD is at the lowest we've seen in multiple years. Do you think that a rate cut is in the offing? Would you be backing it?
Yes, I think definitely we are expecting a rate cut. I think, frankly, if the pressure on the currency would not have been there, I think the probability of even a 50 basis point rate cut would have been there. But I think 25 basis point rate cut probability in the December meeting continues to be high despite whatever recent volatility on the currency we have seen. I think where we need to kind of be watchful of really what is the RBI action on the liquidity front. And if some of the defense of the currency leads to some moderation in the liquidity surplus that has been there in the market. If we look over the last 3 months, unlike last year when RBI tried to defend the currency around 83, 84 levels, the intervention has not drained out liquidity, and that's meant that cost of funding has continued to drop. So I think that is the only piece that we need to watch out for, that even as rates come down, even as RBI kind of steps to curb the volatility in the currency, how does the liquidity environment pan out? The other piece is really in terms of the demand supply for the long duration bonds. I think while liquidity has come in through the CRR cut, this year the open market operations have been limited. And the demand supply of bonds, therefore, has not been as favorable. And that's the reason we haven't seen the drop in the 10-year yields commensurate with the magnitude of rate cuts that have happened. So I think these are the two points that we need to watch out in the policy statement. I think the market is fairly confident about the rate cut coming through.
Ashish, we've got a flash running attributed to you. Big gains in markets unlikely. But we need some gains. Where will those gains come from? Where, would you look to, would one have to venture into slightly more, for the lack of a better word, riskier areas of the market, more, focused on absolute returns, single stocks, and even within sectors which look like they're not going anywhere? So what's the strategy going to be at Axis?
Yeah. So actually, we are seeing over the last quarter, earnings growth recover and coming back even in the large cap space. Right? And if you see last 5-6 quarter, the gap between earnings growth between the mid cap and the large cap space had widened. A large cap earnings growth had come down to low single digit 5-6%. And as I look into the next year, you are actually seeing large cap earnings growth recover. It's recovering in financials. It's recovering in the energy sector. Most of the IT companies are also talking about revenue growth being better than the last 12 months. And we are actually seeing next year earnings growth moving to about 15 to 16%. If you would have seen 3 quarters ago, we were at about 6% earnings growth. This quarter earnings growth for the market has recovered to 10%. But clearly, the large cap earnings growth is picking up, and it's broad-based. If I talk about sectors, of course, financials, both banks and NBFCs, we continue to like. Besides the liquidity, what we are seeing is some early signs of pickup in credit. Asset quality challenges have anyway been modest. We continue to like sectors like power, defense, where there is strong themes of indigenization also playing through. Consumer discretionary is another area we like. So there are multiple sectors to play. And I think it's going to be a better market than what we saw, say, beginning of this calendar year, where the gains were much narrower.
All right, Ashish, always a pleasure talking to you. Thanks a lot for joining in. Wishing you a good day ahead. And we catch up before the end of this calendar year. Thanks a lot for joining in.